Good afternoon. We'd like to thank you for joining the Gabelli Funds live webcast series. Today, we're excited to be joined by Howard Ward and Chris Ward to discuss growth investing for a new decade. Howard is the CIO of Growth Equities at GAMCO Investors and is the portfolio manager of the GAMCO Growth and Global Growth Funds, alongside Chris Ward. Now I'd like to turn the call over to Howard.
Thank you, Chris. Happy to announce that I've just about finished my 25th year of work here at Gabelli. 25 years out of my 42-year career have been here. And also, I wanted to mention that Chris joined the firm about 5 years ago after spending about 5 years at Morgan Stanley. Today, we're going to talk about the current state of growth stock investing at Gabelli. And I'll mention that Chris and I, together with our colleague Caesar Bryan, are responsible for managing the GAMCO Global Growth Fund and the GAMCO Growth Fund. Caesar also manages the International Growth Fund and the Gold Fund. The iShare class of the Global Growth Fund is currently rated 5 stars by Morningstar, while the Growth Fund is rated 4 stars. The Global Growth Fund is up 26.1% year to date, while the Growth Fund is up 29%. The Global Fund has outperformed its index, the MSCI All Country World Index, for the past 1, 3, 5, 10, and 15 years, and that represents the current team's tenure managing the fund. Well, it's obviously been a good year to be invested in stocks this year, especially growth stocks. We have had a defensive tilt to our portfolios for most of this year. We're a little bit less defensive today than we were 3 months ago, but lingering concerns about the outlook and valuations have kept us from embracing a more offensive strategy at this time. My role today is to talk about this macro environment, and then I will turn the mic over to Chris, who will dig a little deeper on valuations and where we see developing opportunities. First, let's just sort of set the stage, if you will, with the global economic outlook. The economy peaked in 2018 in terms of the annual rate of growth. We slowed this year from 2.9 to 2.3%. Of course, that's not all in yet. The expectation for next year is further slowing to 1.8% here in the United States. And when you look at the EU, Japan, and China, you see that the slowdown is covering most of the world's developed economies. In addition to China, and of course, the growth rates for China, we believe, as do many others, we believe they're quite overstated. The actual rate of growth in China is probably half that, and maybe not even that much. In other words, half of around 6%. We have some headwinds. Profit growth has been slowing. It turned negative in the third quarter, and actually, the folks over at FactSet will tell you that the quarterly earnings have been negative for the last 3 quarters. We have trade policy uncertainty, and of course, we read about that every day almost. Continued anticipation of a trade deal, or at least a phase 1 of one that hasn't happened. And believe it or not, the Fed tightening, the 9 moves, the 225 basis points that took place from December of 15 to December of 18, that tightening is still a headwind for the market as it takes 2 full years for all of that tightening to work its way into the economy. We have some tailwinds. The incomes are rising, consumers are spending, wage rate gains are top 3%. We have the lowest unemployment rate since 1969. Lower rates, of course, longer-term rates, those mortgage rates, they started coming down over a year ago. That's been helping the housing sector a bit. And now we're in a full-on global central bank easing cycle, another tailwind. Let's look at the sales, earnings, and dividends with a focus on earnings per share this year and next year projected. For this year, we're looking really at 1.9% growth in earnings for the S&P 500. Of course, that compares to a year ago when earnings were growing at over 20%, so quite a slowdown. Wall Street's still expecting quite an acceleration in earnings for next year, from 1.9% growth this year to over 10% next year. That could be problematic. You know, with the GDP slowing from this year into next year, how we're going to get an acceleration in earnings like that, it's going to be difficult to pull off, particularly because we think margins are more likely to decline than increase. So that number's probably got to come down. There are some models out there now that show expected earnings growth next year that's going to be pretty flat. Here's a chart that shows through the third quarter, the declining rate of earnings growth, that it's evaporating, and we had about 170 companies out of the S&P 500 report negative earnings growth in the third quarter. So not a good picture. One of the things that we're concerned about. However, there is a relationship, of course, between those longer rates and GDP growth. The 10-year, in this case, when the U.S. GDP is reflected with the inverted 10-year with a lag, it looks like we would see a troughing in GDP growth based on this relationship by the fourth quarter of next year. And as we all know, stocks anticipate these developments, which means maybe 6 months before that, the stock market would rally. And so, looking at this particular interest rate stock market model, we'd be looking at a spring rally. That means that the real risk in the market would be between now and the spring, when the difficult time with earnings might be most pronounced. The global PMI has led long rates. This has been a very good forecaster for the economy. The PMI actually leading long rates. And so, it's something that a lot of market participants look at. And, recently the global PMI data has had a little bit of a upturn. However, it's still right around that 50% level. This is the global manufacturing PMI. I just want to point out, because that's the important one. It's got a little bit of an upturn, but I'm not sure it's enough yet to claim that this slowdown is over. This could very well be a counter-trend move, with the primary trend continuing to be lower. I would also point out that the direction of the PMI tends to dictate whether you want to have a higher beta or a lower beta portfolio. When the PMI is rising, a high beta tends to do well, and when it's falling, low beta tends to do well. And so you can see that the lower beta portfolios, the more defensive portfolios, looking at this, should have done relatively better this year, and I think that has been the case for all but the most recent 6 or 7 weeks. If you look at the Fed tightening cycles, you can break the market into 3 different phases. The risk-on phase, when the PMIs are rising, which is when most of the upturn in stocks occurs. The risk-off phase, with PMI still above 50, is sort of a neutral time for the market. You can eke out some meager gains. Stocks tend to rise about half the time. And then you have the situation when PMIs are below 50 and falling. This is the dangerous time when most of the declines in share prices take place. And this is very much the type of environment that we could be in right now. Here we have one way of looking at this in the most recent year, where we've seen going back to the beginning of this rally coming out of the mini recession in 2016. You had, during the risk-on phase, when PMIs were rising, you had almost a 50% gain in the S&P. And then since January of 18, when the PMIs peaked and sort of had started moving down after that, you had a single-digit gain in the market, really, and that's almost a 2-year period of just a single-digit gain. Now, of course, the big question mark is to whether the PMIs will continue to hook higher and bail us out, or whether this is a counter-trend move and will be headed down again, in which case we could be in for a couple of rough quarters for stocks. Some of the things to be expected, before you're in a full-blown risk aversion cycle or phase of the market, you see those manufacturing, ISM manufacturing new orders go below 50, which they have, and they are. You see the economic expectations decline, which they have, although some people are now thinking things are looking up. You see the contraction in earnings growth, and as we've just seen, growth was negative in the most recent quarter and possibly has been negative now for the last several quarters. What we really haven't seen so far is a material rise in the weekly unemployment claims. Even though the 4-week moving average of claims troughed in mid-April, and we've had a little bit of a rise, it's mostly been moving sideways. If this were to begin to break out to the upside, that would be a very negative sign for stocks, given the relationship between claims and stocks, where they tend to diverge. So when claims go up, stocks tend to go down. when claims go down, stocks tend to go up. I want to say a quick word about valuation. First, looking at the forward PE, S&P 500 on forward PE. Back in 2009 at the low, we were at 9 times. The historical average, as you probably all know, is about 15 times. Right now, we're about 18 times forward earnings. So we're above average, a little bit of nosebleed territory, perhaps justifiable by low rates. And it's worth noting that in the March 2000 peak of the dot-com bubble, we were at 25 times forward on the S&P. But let's look at this in a different way. Let's look at the Wilshire 5000 divided by GDP to get a gauge of how we're valuing stocks. Again, in 2009, the Wilshire 5000 represented 65% of GDP. The average over time has been about 80% of GDP. Currently, we're at 150%, which is actually an all-time high, breaking the previous high of 148% set in March of 2000. So as a percentage of GDP, stocks have never been this highly valued before, which is one reason that we think that defensive tilt makes sense. What I'm going to do now is turn it over to Chris and let him dig into this a little bit deeper.
So that is a good segue into talking about asset valuations. So those who are bullish on the economy will probably tell you that there are no obvious excesses to be found. And while that may be true, it makes you wonder if maybe the biggest excess of all is right in front of us. QE and low rates have pushed investors out on the risk spectrum. This has flooded the coffers of venture capitalists and allowed private companies to stay private for longer. But there are inherent inefficiencies in the private markets, as we all know. Private companies are illiquid, they are valued infrequently, and they are valued by a handful of people. So the price discovery process is inefficient. Additionally, because of all the private market capital, when companies are finally registering for an IPO, you really have to question the incentives. You do not want to be on the other side of a trade from a venture capitalist with better information than you, desperate for an exit. So this chart was inspired by an article written by venture capitalist Fred Wilson, in which I elaborated on with some valuation metrics. The blue bars represent gross margins, so you can see the high margin software companies grouped to the left command an average revenue multiple of 14 times. Then on the right are some recent IPOs that are often marketed as tech companies, and yet due to their much lower gross margin profiles, they trade at just 3 times revenue. So on the far right in red, you can see WeWork with gross margins of only 20%, but going into the IPO, it was trying to sell itself as a tech company at about 13 times revenue. So as we all know, SoftBank eventually bailed out WeWork at an $8 billion valuation, implying about 2.5 times revenue, much more in line with the low margin peers. So clearly, WeWork was a unique outlier. It's good to see public markets functioning as they should, but this begs the question, and we think it's a perfectly healthy discussion, is WeWork symptomatic of a bigger asset bubble, and can we justify the valuations that we are paying? So while value investors try to avoid value traps, as growth investors, we try to avoid the snake oil salesman. Some people associate growth investing with speculation and momentum, but our framework is grounded in fundamentals, which we think is especially critical at the bookends of the business cycle. So we want to walk you through our framework today. These are the 5 pillars to our fundamental analysis: low penetration of a large and growing market, a competitive moat, strong unit economics, and trading at a discount to fair value. So with regard to WeWork, and admittedly, this is pretty obvious in hindsight, but when we combed through the S1 in August, it became clear this was not a company that met our criteria. So now let's talk about our framework. Let's talk about FANG within the context of this framework. And from a high level, the consumer internet space, we believe, is relatively well penetrated. There's some optionality from new products, but we'd argue that these companies are so large, it's hard for anything to really move the needle. International markets offer an opportunity for growth, but that incremental revenue growth will be less profitable than a unit of growth in the US. The competitive landscape has intensified, but perhaps more importantly, the regulatory overhang will persist well into the future. So these stocks can still work over time. Their valuations reflect this. They still have moats. They can continue to monetize their installed base, but the days of open-ended growth are over. So where do we see the next big opportunity? If we look back in time, the IBM System 360 mainframe was introduced in the 50s. In 76, Apple released the Apple I. Microsoft eventually commoditized PC hardware, and this was really the start of the client-server model. Commercial ISPs introduced the internet in the 80s, but the internet didn't gain mainstream adoption until later in the 90s. And then the iPhone in 2007 and mobile operating systems led to the proliferation of the consumer internet as we know it, which we'd argue is relatively mature at this point. So where is the next major leg of growth in technology? We believe we are on the cusp of a new computing paradigm enabled by the scalable compute of the cloud and eventually connectivity with 5G, which will support edge computing, Internet of Things, automation, and AI. Some are referring to this as Industry 4.0. So essentially, now that the digital revolution has brought about 4.5 billion consumers online, the next major wave of investment will be focused back on the enterprise as companies invest in their own digital transformation. So these are all areas we are intensely focused on. There aren't necessarily pure play, publicly traded investment vehicles in every vertical, but one beneficiary that is investable today is enterprise software, which is enabling the digital transformation of the enterprise. And there is very real evidence that this is already underway. You can see here, software CapEx has been supporting overall CapEx. Another way to look at it, but within the US Industrial Production Index, tech has been quite strong while manufacturing has been muted. And the proliferation of connected devices is resulting in more data. And for a business, integrating data and analytics into your business decisions has become table stakes. And there's really only one realistic way for a company to make this digital leap, and that's by embracing the scalability of the cloud and cloud applications. And that's reflected here in hyperscale data center growth, which is expected to remain strong. And workloads continue to move to the cloud, with the percent of workloads running in the cloud expected to double in just the next few years. And cloud is lowering the barriers to entry for software developers, resulting in an explosion in third-party applications. And this is contributing to growing IT complexity. So consider the complexity of the IT environment today. You have on-premise infrastructure, public cloud. Many large enterprises are running some form of hybrid multi-cloud. You have internally developed software mixed with hundreds of third-party applications. And this is a huge burden on IT. Companies need to re-architect their data platforms. They need to rethink their security vulnerabilities. They need to adopt new software architectures like microservices and containers. Here you see the top spending priorities for IT departments, things like digital transformation, security, machine learning, data analytics, DevOps. We want to talk about one company in particular that cuts across many of these themes, and we want to tie that into how we think about valuing high multiple stocks. And that company we want to highlight is ServiceNow. So ServiceNow is a leader in IT service management. So you can consider it the central dashboard for an IT department to manage all IT assets. And at the very core of ServiceNow is incident management, which you may think of as ticketing, but ServiceNow is much more than just a ticketing system. ServiceNow integrates with third-party applications and automates many cross-functional IT workflows. It's essentially a system of action that sits horizontally across the enterprise on top of disparate systems of record. So let's see how ServiceNow fits into our investment framework. At $120 billion, ServiceNow is playing in a huge and growing market. Our estimated market share is here at the red line at the bottom. Our revenue forecasts assume ServiceNow can achieve 6% of their TAM by 2025. This is confirmed through bottoms-up analysis, and we think there's room for upside, especially as the company launches new products. And we really think there are two parts to ServiceNow's competitive advantage. First, it's extremely complicated and expensive to switch horizontally embedded enterprise software systems. But if you are looking for a moat that is more tangible, that would be ServiceNow's vast channel partner ecosystem, which includes the global systems integrators such as Accenture and Deloitte. These are huge businesses who themselves are investing behind the success of ServiceNow, and that creates a tight ecosystem of aligned incentives that is very hard to replicate. And here, this is from Gartner. You can visualize ServiceNow's leadership. And based on commentary from management, we would argue their leadership among their target large enterprise customer is even more pronounced. So unit economics, one way we think about this is by measuring lifetime value to customer acquisition costs, which helps reveal the relationship between growth and profitability. Historically, the rule of thumb for a subscription business has been any ratio above 3 is strong. However, because enterprise software is much stickier than a consumer product, the mean across this group is more like 6 times. We used GAAP financials in this in order to account for the variability in stock comp. And you can see ServiceNow scores very well on this metric. Now, this tells us nothing about valuation yet, but this framework does help us model operating leverage over time, specifically on the sales and marketing line. So we think ServiceNow can generate 36% non-GAAP operating margins by 2025, up from about 22% today. Here is our forecasted financial model, and you can see based on our 2020 estimates, the stock is trading at 11 times revenue, 56 times earnings. So how can we justify paying those kinds of multiples? So many high growth stocks are valued on a revenue multiple over the next 12 months, but the next 12-month time frame is extremely efficient and revenue multiples don't reflect profitability. So we solve this by emphasizing a 3 to 5 year outlook and valuing on profitability metrics. This is one way we can express a differentiated view from the market. So because of the deferred revenue component in software, we focus on free cash flow. We look at a group of mature growth peers growing at rates comparable to what we expect ServiceNow to be doing 5 years from now. And we use that average free cash flow multiple to justify a 28 times multiple for ServiceNow in 2025. Discounted back at 11.5%, we think the stock is worth $360 a year from now, up from $270 today. Viewed another way, we think the stock is a double over the next 4 to 5 years. And we think there's a healthy degree of conservatism embedded into our estimates. So ServiceNow meets all of our criteria. Now, if we really see a risk-averse sell-off, then sure, software stocks could be vulnerable, but we'd view that as a buying opportunity for the unique assets in the space. So in conclusion, as far as the economy goes, keep your eye on employment data. It's always healthy to challenge valuation assumptions. And while certain parts of the market might have bubble characteristics, we perform these gut checks on a regular basis to make sure we don't participate in it. And lastly, there are always unique compounding assets to be owned in our universe. And we think the next decade is going to be dominated by themes around Industry 4.0, which is where investors should be focusing. And with that, I'll turn it back over to Chris.
Great. Thank you, Chris and Howard. And we had one question come in offline first. If either Chris or Howard, could you discuss your opinion on the US dollar versus other world currencies going into 2020?
Sure. Thanks, Chris. So as you probably know, for most of the year, the dollar had been in a rising trend, and that ended around the end of September. And it weakened since then and has moved sideways a little bit. In order to believe that the dollar is going to continue to decline, you really have to believe that global growth is accelerating. Because typically what happens is when global growth is accelerating, that means the US is not growing as fast as the rest of the world, and the other currencies are bid up. In order for that to happen, typically you'd see a forecast for stronger global economic growth next year, and that's not the forecast. The forecast is for slower growth. So I think what we're most likely seeing is, again, to use the word a counter trend move, the dollar's in a long-term uptrend. It's seen some profit taking and probably just taking a rest before it continues to move higher. Both the short and long-term growth prognosis for the U.S. is good relative to the rest of the developed markets. We have better demographics, we have better productivity, and we have less regulation. We also have bonds with positive yields, something that I can't say for a lot of the other major developed currency markets. So I don't think that the weakness that we've seen in the dollar since the end of September is really sustainable. I think it's a counter trend move, and we'll probably see the dollar resume an uptrend before too long.
Great. Another question. In regards to the ongoing trade concerns, have you worked to reduce companies within your portfolios who have strong exposure, or have you taken advantage of dips to add to positions?
So we think about the U.S. economy as the lowest beta portfolio in the world economy, and the issue with trade has become its own sort of beta lightning rod. When the news is good on trade, when the White House is talking about an imminent trade deal, which it's now been doing for over a year, that is a risk-on market. And the industrials do well, and the financials do well, and energy and materials do well, and more defensive stocks do less well. And when the trade news is bad, that is a risk-off market, and you get the other impact. For most of this year, as I mentioned at the outset, we've had a defensive tilt to the portfolio, which meant that we had consciously lowered the beta of our portfolio by underweighting or having no exposure in the most cyclical parts of the economy. And so it wasn't so much making adjustments to the portfolio on a stock-by-stock basis. In this case, it was more on a sector-by-sector basis, and that has remained the case thus far. I think it's safe to say most growth portfolios probably have, on balance, that's certainly outside of technology, less exposure to companies with major trade issues with China than a typical value portfolio, however.
Great. Just another quick one here. What is the average allocation between U.S. and foreign? You could give it for both funds, I guess.
Sure. Well, the domestic fund, the GAMCO Growth Fund, is 100% domestic and has been for the last few years. We decided a few years ago to make that an all-U.S. fund. The global fund, to use the name global in your fund, you have to have a minimum of 40% of your assets invested abroad. Currently, and for the last year, most of the time we've had in the high 50% range invested in the U.S., and this has reflected our more bullish stance on the U.S. and less bullish stance on Europe and the emerging markets, and that has been the correct call thus far. That I should point out that a few years ago, the U.S. weighting in the MSCI All Country World Index was down around 42%. I think it's up to about 54% or so now. It's really come up quite a bit. So, having a 58 or 59% exposure to the U.S. is not much of an overweight anymore.
Great. And here's one for Chris. One of the top holdings in the GAMCO Growth Fund is Alphabet. Has the recent stock performance changed your thesis?
So, thanks, Chris. So, I should just clarify again that we still think these stocks can work over time, and I hate to group them all together as FANG because I think they're all very unique in their own way. With regard to Google specifically, we still think it has a powerful moat. It is currently viewed as a good long-term compounder. The few issues we might see with it are, it's possible they did see peak margins. They're increasingly paying for distribution through traffic acquisition costs, which is essentially a payment to Apple to be their default search engine. Regulatory headwinds will persist, if not intensify, even though, ironically, it's kind of funny, GDPR was implemented in Europe in May of last year. And, it's funny that regulation tends to entrench the incumbents, and that's exactly what it seems to be doing in Europe, at least with regard to Google. But regulatory headwinds will persist. The one thing we would be careful of on Google is a lot of people talk about the portfolio of other bets and the optionality you have there. In in our model, we think that in a good case scenario where Waymo is a successful business that might license their technology, however they choose to monetize that, we think you have $70 to $100 per share of value in other bets in a good case. So, that's a 6 to 7% move in the stock. That's really not a meaningful thesis to have if you want to own the stock.
Great. Another question here for Howard. How have unemployment rates and jobless claims been able to remain so low? And what do you think might cause a shift in these relatively positive numbers?
Yeah, this has been a puzzle. Here we are 10 years into an expansion, and we're still churning out 175,000 new jobs on average so far this year. It's a pretty big number. So I have a couple of comments on that. First of all, the margin of error in these monthly numbers, according to the Bureau of Labor Statistics, is 115,000 plus or minus. So these numbers do get revised. They get revised, for a period of several months after the fact. And even then, there's some other fudge factors here that can really distort the numbers. If you're familiar with the birth-death adjustment, this is a biggie. The birth in this case referring to the birth of new companies, which have become an important part in our economy. The government makes assumptions about the number of new businesses and the number of people they're hiring, and it's based on some data that's 5 years old. And so, believe it or not, 46% of the new jobs that have been announced so far this year have been based on assumptions. We don't know whether they're real or not. They're not based on any payroll claims. Many of these companies haven't even set up payroll processing yet. So it's the birth-death adjustment. And the expectation is come March, there's going to be a major review and revision of these numbers. And right now, the estimate is they're going to have a revised out of existence about 500,000 jobs. So stay tuned on that.
Great. Then one more question here. What are some of the factors that could negatively impact this paradigm shift that you were talking about earlier, Chris? Like an example of like cybersecurity or malware.
So absolutely, the more connected endpoints, the more vulnerabilities. But to directly answer the question, I don't think security risks will derail Industry 4.0, but it's going to continue to be an investment cycle into cybersecurity. It'll be ongoing. So Palo Alto is one to watch there, building a platform across cloud, endpoint, and network. That's the primary motivation behind all of their recent acquisitions. There's a recent IPO, Cloudflare, $5 billion market cap, ticker NET, that offers a unique security platform, web and network security, but also routing, switching, DDoS prevention. You can think of this company as sort of a Cisco as a service or a Cisco in the cloud. But from an investment perspective, the security space is so fragmented and dynamic, and it's been hard historically for these companies to really prove a moat. So we prefer to play the theme of IT complexity through the enterprise software players who give you a holistic view of your IT assets.
Great. Howard and Chris, we really appreciate your time today, and we'd like to thank everyone for joining the webcast. Thank you, and we hope you have a great afternoon. Investors should carefully consider the investment objectives, risk, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 1-800-GABELLI or visit www.gabelli.com.